The Smart Investor's Guide to Navigating a Recession and Profiting from It. When headlines scream recession, fear spreads faster than facts. Markets dip, confidence wavers, and many investors rush to the sidelines. But history tells a different story. Recessions don't destroy wealth, panic does. For smart investors, downturns are not disasters. They ray opportunities in disguise. This guide breaks down how to protect your capital, spot hidden opportunities, and position yourself to profit when the economy slows. 1. Understand the nature of a recession. A recession is a period of economic slowdown marked by reduced spending, rising unemployment, and declining business activity. While uncomfortable, it is also temporary. Markets have always recovered and often rewarded those who stayed disciplined. Key mindset shift. Don't ask how bad will it get, ask where will value emerge. 2. Cash is not trash, it has power. In boom times, cash feels unproductive. In recessions, it becomes a strategic weapon. Why cash matters. Lets you buy high-quality assets at discounted prices. Reduces emotional pressure during market drops. Provides flexibility when opportunities appear suddenly. Smart move. Keep an emergency fund and an investment reserve ready for market pullbacks. 3. Focus on quality, not hype. Recessions expose weak businesses and reward strong ones. Look for companies with strong balance sheets, consistent cash flow, low debt, essential products or services. These businesses may fall in price, but their fundamentals remain solid, making them prime candidates for long-term gains. Price falls. Value often doesn't. 4. Defensive sectors become offensive opportunities. Some industries perform better when the economy slows. Traditionally resilient sectors include consumer staples, food, household goods, healthcare, utilities, discount retailers. These sectors may not sound exciting, but during recessions, boring can be profitable. 5. Diversification is your shock absorber. Putting all your money in one asset or sector increases risk, especially in uncertain times. A recession-smart portfolio may include stocks, growth plus defensive, bonds or fixed income assets, cash, alternative assets depending on risk tolerance. Diversification doesn't eliminate losses, it controls them. 6. Dollar cost averaging beats market timing. Trying to predict the exact bottom is a losing game. Instead, invest consistently over time. Buy more when prices are low, less when they ray high. Remove emotion from decision-making. This strategy turns volatility into an advantage rather than a threat. 7. Recessions reward patience, not speed. Many investors lose money not because they chose bad assets, but because they sold too early. Remember, markets often recover before the economy does. The biggest gains frequently happen right after the worst news. Long-term investors benefit from staying invested. If your strategy hasn't changed, short-term fear shouldn't change your actions. 8. Invest in yourself. One of the most overlooked recession investments is knowledge. Use downturns to learn financial literacy, study market history, analyze past recoveries, improve decision-making skills. The return on education compounds for life. Final thoughts. Turn fear into strategy. A recession is not a signal to retreat, it is a test of discipline, patience, and clarity. While many investors freeze or flee, smart investors prepare, observe, and act with intention. Wealth isn't built by avoiding downturns. It is built by navigating them wisely. If you stay calm, stay informed, and stay focused on long-term value, a recession can become one of the most profitable chapters of your investing journey.